If you're 45 or older and you're just starting to invest, you are not alone. I started seriously investing at the age of 50 and I know how overwhelming it can feel. You want to grow your money, but you also don't want to lose it chasing risky bets. But even with a few mistakes, my portfolio's grown more than I expected in just 2 years. So in this video, I'm breaking down 3 simple ETF portfolios that were designed based on my experience, which could work for Canadian investors starting late. From the conservative to income heavy approach, even if you're starting late, you can still build real wealth. My name is Darren. I'm just a regular Canadian who used to think I was too late to start investing. But I started anyway, and now I'm proving that it's never too late to build wealth. I started my investing journey with $200,000 and have grown this to $360,000 in just over 2 years with no financial background or absolutely no experience. So no, this isn't a best case scenario, and it's definitely not a get rich quick story. It's just a real one, something you can actually build on. And to be honest, it hasn't been all perfect. I've made some poor decisions like buying QQQY and Enbridge early on. But even with those mistakes, the strategy still worked. That's what I want to show you guys today with these portfolios. This video is focused on Canadian ETFs and account types like the TFSA and the RRSP, but the core principles apply no matter where you live. So if you're in the United States, you can use similar ETFs like VOO instead of VFV, and accounts like the Roth IRA or the 401k instead of the TFSA or RRSP. The structure stays the same, it's just the tools that change. But before we do that, I want to give a big thank you to all of you. Since my last video, this channel has grown by over 1,000 new subscribers. I asked, man, and you guys stepped up. The comments have been incredible. People are saying they're glad that they found this channel and that seeing someone who started late like them is actually motivating. So thank you. Every time you guys hit like or subscribe, it tells the YouTube algorithm that this content matters. And those 1,000 new subs are proof that it works. It helps this reach others who need it as well. And if you haven't subscribed yet, you still can make a real difference. Let's hit that subscribe and like and push this content to others who could benefit from it. If you're like me, you probably grew up thinking the smart thing to do was to save. How many will resonate with my parents always told me to keep my money in a savings account? Or maybe even a GIC if I wanted to earn a little bit more interest. That was considered safe and responsible, and back then, it actually worked. Interest rates were a bit higher, and just putting money away felt like it was enough. But now that I've started investing later in life, I realize what I missed out on. Not because I was reckless, but because I didn't know there was another option. For example, if you're 10 to 15 years away from retirement like I am, you probably still want a little bit of growth, but you might also want monthly income to feel a bit more secure. That's where my new 80-20 approach comes in, and I'll show you how I'm shifting my portfolio a little bit later in this video. The truth is, the stock market isn't as intimidating as I thought, especially when you use simple tools like ETFs. You don't need to pick stocks or time the market, you just need a strategy that helps your money grow steadily over time. Of course, when you go online and you see all these traditional strategies, the 60-40 portfolio, the 4% rule, shifting into more bonds as you get older, this is where people get bogged down and overwhelmed. Now, there's nothing wrong with this simple approach because you're not going to lose your money, unless the financial institution goes belly up, of course. But even if that happens, your money is still protected here in Canada. Now, while those approaches can work for some people, if you're starting at 45, 50 like I was, or even 60, it can feel like a lot of this is really out of reach or like you're already way behind. I started investing in April of 2023, and to give you a real example, here's what VFV, a Canadian S&P 500 ETF I've held, has done since then. Now here's a 10-year look at how the S&P 500 compares to something more like a traditional GIC. We can clearly see here that buying and holding an ETF like VFV will grow your money far more than a GIC. But of course, you have to remember that this approach is not risk-free, so understanding your risk tolerance is important. I consider myself a conservative person who likes to make informed decisions. These informed decisions have grown my VFV investment by 40%, as you can see here with this portfolio tracker in Blossom Social. I did nothing more than some research, set an asset allocation, and dollar cost average into VFV. These portfolios aren't fixed formulas. You have to think of them as frameworks that you can mix and match based on your timeline, your risk tolerance, and your goals. The truth is there's no one-size-fits-all strategy. That's why I'm not giving you a rule book here. I'm just giving you a few simple portfolios that you can adjust based on how long you plan to invest, how much income you want, and how comfortable you are with market ups and downs. Now, I want you to imagine you're 45, unlike when I started. You could have about 20 years of investing time ahead of you. Even at 55, which is only a few years older than me, you still have time, especially if your goal is to semi-retire or live off of your investments later. The point is, safety is important, but so is growth, and the right mix depends on you. Now, I'm not a financial advisor, I'm just a regular Canadian sharing my personal investing experience. And the portfolios and the ETFs that I'm mentioning here are based on what I've done and what's worked for me. They may not be right for everyone, and it goes without saying that you should do your own research or you should speak to a qualified advisor before you make any investment decisions. It's also important to remember that the securities that I talk about aren't the only options out there. They're just the ones that I have personally used and have worked for me. So let's start with something that might feel a bit familiar if you're coming from a GIC or a savings background. The first portfolio is built for stability, some modest income with a strong Canadian foundation. So we're going to start out with 40% into VFV or the S&P 500, 30% into XIC, which is the broad Canadian market, 20% into XEI, which is a Canadian dividend income fund, and 10% into ZAG, which is Canadian bonds. The idea here is to keep it simple, low cost, diversified across sectors and regions, but still have a safety net with something like ZAG for the stability. This portfolio leans toward capital preservation while still giving you exposure to long-term equity growth and some monthly income. This might work well for someone who's already retired or just a few years away and wants some growth, but doesn't want to stomach too much volatility. And remember, you can always adjust this depending on your comfort level with risk or the need for income. Now, this next portfolio is a lot closer to what I started with. Growth focused, globally diversified with a bit of passive income built into it. So we start off with an allocation of 45% into VFV, which is the S&P 500, 15% into XIC and XEI for Canadian dividends, 15% into XEF for international developed markets, 10% into XEC or emerging markets, 5% into QQC, which is the NASDAQ 100, and 5% into VRE Canadian REITs, and then finally 5% into HYLD for some monthly income. This portfolio gives you access to global equity growth with a strong US base, but also some Canadian and international diversification. And that's the key, is diversification. When one area of the market is down, another might be up, and this mix helps smooth out the ride and keep your portfolio growing steadily over time. And I've included a small allocation, just 5%, in an income-generating ETF like HYLD. It might not seem like much, but when I started, HYLD was actually my main income fund. I just wanted a bit of monthly cash flow to keep me engaged while the rest of my portfolio focused on growth. Now, this kind of balanced portfolio is great for someone who's 10 to 15 years out from retirement, who still wants a bit of growth, but doesn't want to miss out on the passive income either. And spoiler alert, like I said, this is very close to the blend that I use in my portfolio right now. Now, before we jump into portfolio number 3, you might be wondering, how do I actually manage all of these ETFs, keeping track of the allocations, the rebalancing, and staying organized can feel quite overwhelming, especially if you're new to all of this. That's where a tool like Passive comes in. It connects directly to your brokerage account and it helps automate your ETF investing, showing you exactly what to buy to stay on track and helping you rebalance with just a few clicks. I use it to manage my own portfolio and it's been a huge help. It takes the guesswork out of maintaining these kinds of diversified allocations. The free version of Passive is great for pretty much everybody, but if you want access to a bit more advanced features, there is a premium version that costs $99, or if you're a Questrade user, it's free. Now, if you use my affiliate link in the description below, you'll save on the cost and you'll also be supporting this channel since I do get a small kickback from that, along with all the other affiliate links down below for things like Wealthsimple and EQ Bank. This last one is a bit of a twist on some of the traditional portfolio advice that you guys might hear out there, and it's how I'm structuring my investments today. But let's be clear here, because this is something that I built based on my experience, and I don't know exactly how it's going to turn out, and I'm still testing and learning like everyone else, why you guys even watching me. Now, traditionally, an 80-20 portfolio means 80% in stocks and 20% in bonds. It's a common strategy that balances that long-term growth with some downside protection. It's often used by people in their 40s or 50s to reduce some risk as they approach retirement. But in my case, I put a bit of a spin on that, and I'm going to use 80% growth through equity ETFs and 20% into income-generating covered call ETFs. So instead of bonds, I'm using that 20% to get some monthly income. What I do know is that for where I am right now in my 50s with about 10 to 15 years left to grow my portfolio, this approach makes sense to me. Now I've found a bit of a better balance because the 80% growth gives me that long-term upside I still need, while that 20% income gives me monthly cash flow without relying on risky picks. So we'll have to see how all of this works out. All right, so the allocation looks like this. 80% goes into VFV, XIC, XEI, XEF, XEC, and QQC. The remaining 20% goes into a covered call ETF like HYLD for that monthly income. So you have to stay tuned for more of my videos to see how this all works out. For me personally, in my 50s and still working toward retirement, this feels like a good balance. I still want some of that growth, but I also want some of that monthly income, because if another big bill like that furnace one hits that I had, and as always, this is a starting point. You can dial the income side up or down depending on your needs and your comfort with the market volatility. But here's the lesson I really want to leave you guys with. If you're starting late, yes, growth and income are important, but so is being prepared for the unexpected, because that $16,000 bill taught me the importance of an emergency fund more than anything else. So I hope that this gives you some ideas to work with, and maybe a bit of reassurance that starting later doesn't mean starting wrong. And if you're wondering whether you should be investing at all right now, especially if you're still paying off some of that debt or you haven't built that emergency fund yet, you should definitely watch this video right here, because that $16,000 furnace bill changed everything for me, and it's one of the most important lessons that I've learned since I started investing.